What if the price on your screen right now has absolutely nothing to do with the actual price being paid for silver at this very moment? What if $67.97, the number every chart, every ticker, every mainstream financial outlet is feeding you, is a fiction, not a mistake, not a lag? A deliberate structural fiction maintained by a system that is running out of the one thing it needs to survive: physical metal. That is the question nobody on financial television will ask you. And that is exactly the question we are going to answer in the next several minutes. Because what is happening inside the silver market right now, in the final days of March 2026, is not a correction. It is not a pullback. It is not healthy profit-taking. It is the visible fracture of a pricing system that has controlled the white metal for over 4 decades. And the data proving it is not hidden. It is sitting in plain sight on the CME Group's own depository reports, on the Shanghai Gold Exchange's own benchmark filings, on the LBMA's own lease rate disclosures. All you have to do is look. My name is OG John AG. This channel exists because the information you are about to hear does not get reported anywhere else in this format, raw, unfiltered, and built entirely on verifiable numbers. If that matters to you, the subscribe button is right there. No pressure. But what I am about to show you might change how you look at every silver price quote for the rest of your life. Before we touch a single data point, consider this. 5 major banks have already been criminally charged and fined a combined $1.2 billion for manipulating the silver market. JP Morgan alone paid $920 million in 2020 and admitted wrongdoing to the United States Department of Justice. Scotiabank settled for $127.5 million, HSBC paid $76.6 million, Deutsche Bank paid $75.5 million, Morgan Stanley added another $1.5 million. All caught, all fined, all engaged in spoofing, flooding the market with fake sell orders to push prices down, then buying at artificially depressed levels. Between 2008 and 2016, these institutions systematically rigged precious metals through spoofing, price manipulation, and benchmark fraud. Regulators caught them. Convictions and settlements spanned from 2016 through 2025. That is not conspiracy. That is court record. And the question nobody in mainstream finance wants to engage with is simple. If it happened before, under sworn admission and criminal penalty, what makes you confident it is not happening right now? Keep that in the back of your mind as we walk through what just happened this week. Let us start with the price action. On March 25th, silver opened at $72.60 per ounce, a solid number, up $2.47 from the prior session, up over $38 from where it traded 12 months earlier. The trend was intact, momentum was healthy. Then March 26th hit. Silver dropped $4.85 in a single session, one day. Nearly a 7% move to the downside. The price landed at $67.75. By March 27th, there was a small recovery, 22 cents, to $67.97. But zoom out from the weekly noise and the picture is far more violent. On March 5th, silver was trading at $82.78. That means in 3 weeks, the metal has lost roughly $15 per ounce, an 18% decline. And if you pull the lens back even further, the all-time high was $121.67, set on January 29th, 2026. Silver has now fallen nearly 45% from that peak in less than 60 days. So the obvious question, the one every retail investor and every stacker and every fund manager is asking, is whether the rally is over, whether the structural thesis has broken, whether the people calling for triple-digit silver were simply wrong. Hold that question, because the answer lives inside 3 datasets that contradict the price action so completely, so violently, that you will need to decide for yourself which version of reality you believe, the paper version or the physical one. Dataset number 1, COMEX Vault Inventories. As of the last reporting cycle, registered silver on the COMEX, the metal that can actually be delivered against futures contracts, has declined 11.5% in just the past 30 days. That is 10 million ounces withdrawn in a single month. The coverage ratio now stands at 13.5%. That is deep in stress territory. Paper leverage has risen to 7.4 times, meaning for every ounce of deliverable metal sitting in those vaults, there are 7.4 ounces of paper claims floating above it. And here is the number that should stop you cold. At the current pace of withdrawals, registered silver on the COMEX would be completely exhausted in approximately 170 trading days. Not years, not decades, 170 sessions. That is roughly 8 months from now if the drain continues at this speed. And the drain is accelerating, not slowing. The April 2026 first notice day is now just 2 business days away. There are still 1,981 open contracts representing 9.9 million ounces. Those contracts either roll, settle for cash, or demand physical metal. Every single one of them creates pressure on a vault system that is already bleeding. Now, broaden the lens. Total COMEX silver inventory sits at roughly 440 million ounces. That sounds comfortable until you realize only 124 million of those ounces are registered. Less than 30% of the silver sitting in those vaults can actually be delivered. The rest, eligible silver, is privately held metal that happens to be stored there. It cannot be touched without the owner converting it to registered status, and owners are not converting. They are doing the opposite. In February, registered silver stocks fell below 90 million ounces. Total inventory has crashed roughly 31% since October 2025, dropping from approximately 532 million ounces to around 366 million. On February 11th alone, one single day, the COMEX reported a withdrawal of 3.26 million ounces from the registered category. That pushed total registered below the psychologically critical 100 million ounce threshold. The eligible category lost another 4.7 million ounces the same day. A net vault outflow of nearly 8 million ounces in 24 hours. Since 2021, registered silver available for delivery has declined by over 70%. And here is where the math becomes genuinely uncomfortable. Open interest on COMEX silver futures often represents 10 to 20 times the available registered inventory. If even 5% of contract holders demanded physical delivery simultaneously, the exchange could not fulfill those requests. The entire system is built on one assumption, that most participants will never ask for their metal. That assumption is now being tested every single month. In January 2026, 49.4 million ounces stood for delivery. That is more than 7 times what January 2024 generated. All of 2025 combined settled 474 million ounces, more than double the 203 million ounces settled in 2024. This is not a blip. This is a trend with a trajectory, and the players involved are not small retail stackers. In early January, JP Morgan issued 99% of 8.1 million ounces in delivery notices in a single day. They were on the selling side. The metal was moving. But here is the part that broke the pattern. Despite those massive deliveries, open interest in the contract actually increased by nearly 1,500 contracts the same day. New buyers were arriving faster than metal was clearing. The Sprott Physical Silver Trust, one of the largest allocated silver funds on the planet, doubled its capital raise program in January to $2 billion. At prevailing prices, that was enough to purchase roughly 18 million ounces. That single institutional move represented approximately 16% of COMEX registered inventory. One fund, 1 month. 16% of the deliverable supply. And there is a market signal hiding inside the futures curve that most retail investors never look at. Silver has entered backwardation. That means the spot price, what you pay for metal right now, is higher than the futures price, what the market says silver will cost months from now. In a normal, healthy market, futures trade above spot because of storage and carrying costs. When that relationship inverts, it means one thing. Immediate physical demand is so intense that buyers are willing to pay more for silver today than the market expects it to be worth tomorrow. Backwardation in precious metals is not common. When it appears, it is one of the clearest warning signals that something in the physical supply chain is breaking. So if the physical market is this tight, if the vaults are draining, if institutions are lining up to take metal off the exchange, then why is the paper price falling? Why is the number on your screen showing $67 when the physical market is screaming something entirely different? This is where dataset number 2 enters the picture, and it is the one that should genuinely alarm you. Shanghai. The silver price in China is not $67. It is not $72. It is not even $90. Physical silver on the Shanghai market has traded at sustained premiums as high as $120 to $130 per ounce. That is a 40% to nearly 100% premium over what COMEX quotes. In a functioning integrated global market, that kind of spread gets arbitraged away within hours. Traders buy cheap silver in New York, ship it to Shanghai, sell it at a premium, and the gap closes. That is how markets are supposed to work. But the gap is not closing. It has been persistent for months, and the reason it is not closing is because the silver that would normally flow from west to east cannot move. China reclassified silver as a strategic material on January 1st, 2026. Not a minor policy tweak. A full reclassification, placing silver in the same regulatory category as rare earths. Export licenses are now granted only to 44 approved firms. Those firms must produce at least 80 tons of refined silver annually and maintain credit lines above $30 million. Everyone else is locked out. The Chinese state-run Securities Times confirmed that this policy formally elevates silver to the same regulatory footing as rare earths. Elon Musk himself responded on X, saying silver is needed in many industrial processes, but the policy stands. And the impact is staggering. China controls an estimated 60% to 70% of global refined silver exports. That pipeline has now been placed behind a licensing wall. If Chinese exports drop by 50%, global deficits could exceed 5,000 metric tons annually. That is not a speculative number. That is an institutional projection based on current consumption rates and mine output trajectories. The global silver market has effectively been split into three isolated islands: Asia centered on Shanghai, North America centered on COMEX, and Europe centered on the LBMA. Each one is now pricing silver differently based on local supply conditions rather than global equilibrium. The arbitrage mechanism that is supposed to keep prices aligned across markets has broken because there is not enough movable metal to make the trades work. Once you add freight costs, insurance, and lease rates above 7%, transatlantic shipments to refill London's inventories stop being profitable. The metal is trapped where it sits, and where it sits increasingly is the East. In a moment, I am going to show you the lease rate data that confirms this fracture from the financial plumbing side. But first, there is a geopolitical overlay that most silver analysis completely ignores. Iran has declared it will not negotiate with the United States and is now charging yuan-denominated tolls on Strait of Hormuz oil shipments. That is a simultaneous escalation of military tension and a de-dollarization move that directly impacts how precious metals get priced globally. The Federal Reserve held rates at 3.50% to 3.75%, a hawkish stance that oscillating oil prices and a widening Middle East war have made even more complicated. Gold is headed for a weekly loss of close to 9%. Silver tracked more than 10% down for the week ending March 20th. The convergence of war, monetary policy uncertainty, and energy disruption is creating the exact environment where physical precious metals diverge most violently from their paper representations. Dataset number 3 confirms the fracture from the financial plumbing side. Lease rates. In a normal silver market, 1-month lease rates sit between 0.3% and 0.5%. Quiet, stable, boring. By January 2026, that rate exploded to approximately 8%. During peak stress moments, lease rates surged to more than 30 times normal levels. That is not a market functioning under healthy conditions. That is a market where institutions are paying extraordinary premiums just to borrow silver for short periods because they cannot source it any other way. The LBMA, the heart of global spot silver trading, saw its eligible silver stocks shrink to only about 155 million ounces by 2025. Meanwhile, floating annual demand runs between 900 million and 1.2 billion ounces. The math does not work. There is not enough metal in the system to cover the promises that have been made against it. And here is a detail that most analysts conveniently forget. In 2021, the LBMA overstated its silver holdings by approximately 3,300 tons. They later called it a calculation error, a clerical mistake. But that supposed mistake was worth over $3 billion at the time, and it left a permanent scar on market confidence. If the institution responsible for benchmarking global silver prices cannot accurately count how much metal it has in its own vaults, what exactly is the benchmark measuring? The paper-to-physical ratio has stretched as high as 356 to 1. For every single real ounce of silver, there are 356 paper claims sitting on top of it. That is not a market, that is a confidence game, and confidence games work perfectly right up until the moment they do not. Now, I promised honesty, and honesty requires looking at the other side of this. The bearish case exists, and it is not stupid. Silver has a history of vertical rallies followed by violent collapses. The Hunt brothers in 1980, the parabolic run to $49 in 2011. Both ended with the exchanges raising margin requirements and the price cutting in half or worse within weeks. On January 7, 2026, the CME raised silver maintenance margins to $30,500. That triggered forced liquidations across leveraged accounts. The 34% single-day crash on January 30th, the largest in recorded history, wiped out over $3 trillion across gold and silver combined. Gold dropped from $5,597 to $4,686 in less than 24 hours. Silver went from above $110 to $74 in the same window. The speed was breathtaking, and there is a new variable that was not present in previous cycles. Bloomberg data and expert commentary have identified a billionaire Chinese trader who reportedly built the largest net short position in silver on the Shanghai Futures Exchange. A single massive short position from a single participant potentially impacting global prices. That is not COMEX-based manipulation. That is a new center of gravity for price suppression originating from the East. Some analysts argue this was not manipulation, but classic crowded trade mechanics. Prices ran too far too fast. Momentum traders piled in. When the margin call hit, the unwind was violent but mathematically predictable. The SLV ETF recorded $14.3 billion in single-day trading volume near the peak, a classic blow-off top indicator, and the broader macro picture is not uniformly supportive. The Federal Reserve held rates at 3.50% to 3.75%, a hawkish stance. Higher rates raise the opportunity cost of holding non-yielding assets like silver. An escalating conflict between the United States and Iran is whipsawing energy prices and creating risk-off sentiment that does not always favor metals. These are real headwinds. They deserve respect. Dismissing them is not analysis. It is religion. But here is what the bearish case cannot explain. The vault drain has not stopped. The delivery demand has not slowed. The Shanghai premium has not closed. The lease rates have not normalized. And the supply deficit is not getting smaller. Chris Powell, co-founder of the Gold Antitrust Action Committee, stated in a March 21st interview that government intervention in gold and silver markets is not only real, but legally authorized under existing United States statutes. GATA has spent over 25 years collecting official records, central bank communications, and policy documents that they argue demonstrate a consistent effort by Western governments to influence precious metals pricing. Powell specifically pointed to the growing tension between paper markets and physical reality, describing gold and silver markets as heavily leveraged with far more paper claims than actual metal available. He argues that recent price surges represent early signs that the market is beginning to break free from constraints that have held for decades. You can dismiss that as conspiracy, or you can weigh it against the vault data we just reviewed and decide for yourself. The structural supply picture is where the bearish case falls apart entirely. The structural supply picture is where the bearish case falls apart entirely. The Silver Institute confirms 2026 will mark the 6th consecutive annual market deficit. Not 2 years, not 3, 6 in a row. The cumulative shortfall from 2021 through 2025 stands at nearly 820 million ounces, almost a full year of global production consumed from above-ground stockpiles that are not being replenished. Every year the deficit continues, the buffer gets thinner. Every year the stockpile shrinks, the system moves closer to the point where paper promises collide with physical reality. Total 2026 supply is estimated at roughly 1 billion ounces, 820 million from mines and 180 million from recycling. Total demand is projected at 1.18 billion ounces. That is a 180 million ounce gap, and the demand side is not discretionary. Industrial silver use hit an all-time record of 680.5 million ounces in 2024. Solar energy alone now accounts for over 30% of industrial demand. Each photovoltaic panel requires 15 to 25 grams. Global installations hit 380 gigawatts in just the first half of 2025, a 64% jump from the same period in 2024. A single electric vehicle uses up to 50 grams of silver, roughly double a traditional car. The European Union has mandated solar integration in new buildings starting this year. India became the world's largest importer of refined silver, with imports estimated at $9.2 billion, a 44% increase over 2024. The Reserve Bank of India will begin allowing silver as loan collateral at up to 85% loan-to-value starting April 2026. Silver prices in India have nearly tripled in rupee terms, climbing from around 80,000 to 85,000 rupees per kilogram to above 2.43 lakh. JP Morgan Global Research sees silver averaging $81 per ounce in 2026, more than double its 2025 average. They specifically note that any revival of tariff investigations could trigger another wave of metal, moving from London to New York, tightening physical liquidity outside the United States even further. And they are not the only ones positioning for what comes next. The gold-to-silver ratio currently sits near 64.6, compressed from over 100 in April 2025. That 45-point compression is not noise. It is institutional capital rotating from gold into silver at a scale that only happens when the smart money sees asymmetric upside. They are not running from this metal. They are stacking into it while the paper price gives them a discount that the physical market no longer offers. While the paper price says $68, the physical market is saying something the paper system cannot afford for you to hear. And that is the real question this data leaves you with. Not whether silver is going up or down next week, not whether the next margin hike triggers another flash crash, but something far more fundamental. If the paper market and the physical market are telling two completely different stories, and one of them has to be wrong, which one are you betting your financial future on? The one backed by warehouse receipts and futures contracts that outnumber real metal 356 to 1, or the one backed by bars being loaded onto trucks in New Jersey, shipped to vaults in Shanghai, and locked behind a government licensing wall that did not exist 90 days ago? The answer to that question is not something I can give you. It is something you have to decide for yourself. But at least now you have the data to make that decision with your eyes open. If this changed how you think about silver, even a little, share this with one person who needs to see it. Drop a like so the algorithm pushes this to more people who are not getting these numbers from mainstream financial media. And if you watch this far, you already know you are not a casual viewer. You are part of the minority that reads the vault reports while everyone else reads the headlines. Prove it Drop the words OG John AG 2.0 in the comments right now. When I see that phrase, I know exactly who stayed until the last word. And I build every single video for you. Invest with logic, never with noise. OG out.